How robust is the current state of the economy? Are stock market valuations too high? These are questions on the minds of many as we navigate the evolving landscape of global finance. Drawing from the insights of Jim Bianco, let's delve into some key conclusions about the market outlook. The US economy is robust, perhaps excessively so, while the rest of the world, including China, Europe, and Japan, is grappling with economic challenges. Stock market valuations by historical standards are exceedingly high. The next decade might bring lower returns of 5 to 7% annually, a significant drop from the 20% plus gains of recent years. In this climate, active management and stock picking are likely to gain importance over passive investing. Let's now turn to the key risks. The so-called Magnificent Seven tech stocks represent about a third of the S&P 500, creating a high concentration risk. Many investors, often unknowingly, are heavily exposed to these stocks through index funds. The benefits of the AI revolution may take longer to materialize than current valuations suggest. The demographics are also concerning, with 80% of equities owned by individuals over 55, who may not have the luxury of time to wait out extended sideways markets. Bonds, traditionally seen as a protective asset when stocks fall, may no longer provide this safety net. Bonds and stocks have become more positively correlated due to inflation concerns. While bonds offer lower volatility and decent yields of around 5%, they may no longer provide the crash protection they once did. This leads us to the implications for investment. Investors may need to rethink portfolio construction, perhaps considering a 40% bond, 20% broad indexes, and 40% thematic stock picking split. The era of easy returns through passive investing may be coming to an end. Many current investors or traders are more like speculators and lack experience with active management. Historically, true outsized returns have come from entrepreneurship and business building, not passive investing. Bianco's major themes reveal a fundamentally different position for bonds now compared to 2022 to 2023. Even with some yield increases, total returns can still be positive. The inflation outlook points towards a fire world rather than an ice world, with a structural 3% inflation seen as the new normal. Markets and policy also raise questions, particularly the Fed's view that the economy is normalizing to pre-pandemic conditions. The implications for portfolios are significant. A balanced approach with a substantial bond allocation is advised. Investors should look for opportunities in beaten-down areas like European stocks, focus on achieving real returns above inflation, and be realistic about return expectations. Bianco's key advice for individual investors is to focus on building wealth through your job or business, rather than expecting outsized investment returns. Have realistic expectations. Aim to beat inflation moderately rather than seeking dramatic gains. Consider professional management for more speculative portions of the portfolio. And remember, dramatic changes like those seen in 2020 can permanently alter market dynamics. The overarching message: prudence and moderation. Steady wealth building through work and maintaining realistic investment expectations in a potentially more challenging market environment are key.